Danny, I'll tell you, I sort of feel like the Forrest Gump of finance. I've been at the right place at the right time.
Joseph DaGrosa.
Joseph E. DaGrosa.
Joseph DaGrosa.
Today's guest is Joseph E. DaGrosa, Chairman and CEO of Axxes Capital and a private equity veteran with over 30 years of experience across real estate, aviation, and more.
Joe shares the mindset, the strategies, and the investment insights that turn ambition into lasting wealth.
I'm a deal junkie. That is a vice of mine.
Oh, wow.
And I think, a lot of people are deal junkies. And human nature being what it is for a deal junkie, you want to get the deal done. And I think what I've learned at this stage in my life is sometimes it's much better to take a pass. I remember Warren Buffett once said, when you're in the batter's box, you can let a lot of strikes go by. So long as you don't swing, you're never going to be called out. It's when you swing and miss that it becomes a problem.
The responsibility that you take on, right? Whether things go right or wrong, it's always your fault.
Yeah, it's very funny. You're either a genius and you don't deserve to be called a genius, or you're a complete idiot and you may or may not deserve to be called a complete idiot. But there's generally nothing in between. Those are the extremes in my business.
Why is it that you think that you've been able to be so successful across a myriad of different asset classes and strategies?
Well, I think, first of all, there's a bit of a method to the madness in the following respect. I do think through a certain prism, and one of those prisms is...
The majority of Americans have zero exposure to private markets.
Yeah, absolutely.
Right? Zero exposure to
you have no question about it.
The average American has 95% of their investable assets in public securities.
Yeah.
Isn't it crazy?
It is crazy. Yeah.
That's insane. Really stuck out to me. One of the very first business podcasts that I listened to when I just graduated college. How do you do what you do? And the guy said, I find a need and I fill a need.
Yeah.
It's like, I find a need.
That's right. It's really that simple. That's what we did with Axxes. But, there's another element to Axxes. There's another need that we're filling that we don't really talk too much about, but I'll mention it here.
Welcome to the Investing Secrets Podcast.
Joe, welcome to the vault.
Thanks, Danny. Great to be here.
Yeah, I'm excited to have you here, man, and dig into all the great investing secrets that you've got for us here. So why don't we just start off with the basic, just fundamentally how you got into this business, right? How is it that you kind of got to this point? Because I don't think that many people kind of grow up saying you know what, I think I want to get into private equity. I think I want to get into real estate, build a REIT and do all these really cool things. So how did you kind of find your way into this niche?
Well, Danny, I'll tell you, I sort of feel like the Forrest Gump of finance. I've been at the right place at the right time. So a lot of it has been, I don't want to call it all dumb luck, but, certainly being at the right place at the right time and taking advantage of opportunities. Now, I began my career and I had the benefit of growing up in New York. So I started working on Wall Street when I was 15 years old as a messenger. And so, by the time I graduated college, I had, worked on the commodities exchange floor. I'd worked for the CFO of Paine Webber, which is now part of UBS. But at 15, I was, carrying stock certificates from the Midtown offices of Paine Webber down to their vaults. So I was very lucky in that I knew very early on that was a business that I liked. I was intrigued by Wall Street and the exciting world of finance. After college, and I went to Syracuse, I wound up studying finance, accounting, and statistics. And I mentioned that because I was very numbers oriented. And never in my wildest dreams did I think that I would ever be selling anything to anyone. I was a bit of an introvert. And so, but I love numbers. And so that's really where I got my start. And Wall Street is very numbers oriented. First 2 years, I was an auditor for Paine Webber. And right place, right time, an opportunity to become a wealth advisor. And that was, I hate to even say how many years ago it was, but it was in 1988 that I became a wealth advisor. And I did that for the next 8 years. And I was fortunate in that I managed money for the senior executives at Paine Webber. They introduced me to some institutional accounts, one of which was one of the pioneers in private equity. And back then, back in the 80s and early 90s, it wasn't even called private equity. It was called leveraged buyouts. And so one of the rock stars of the leveraged buyout era was my old boss, Bob Glazer. He had acquired Tiffany's and Saks and Gucci. Oh, wow. Very well-known guy. And he really gave me my start. So I left Wall Street and I joined Maplewood Partners as Bob Glazer's first partner. And I learned the ropes from him. He was, rock star in private equity back then. Once he had leveraged buyouts, and I learned at his feet how to acquire companies.
Amazing. And so, at what point did you go from that to real estate? Right. So at some point you just started with the real estate thing too. Yeah.
Well, it's funny. I moved to Miami 27 years ago, and I wish I'd gotten into real estate 27 years ago, but I was very focused on private equity. And so in 2003, I left Maplewood Partners. A partner and I wound up buying a whole bunch of Burger Kings out of bankruptcy. We created the second largest franchisee in the Burger King system, sold to Blackstone in 2006. It was a deal that worked out extraordinarily well. We sort of rode the coattails of Goldman and Texas Pacific Group and Bain Capital that acquired the franchisor, and we built up very rapidly the second largest franchisee, and we sold it very profitably. From there, I went on to acquire an insurance company with a number of partners. I served as vice chairman and co-chief investment officer, so I managed a pretty large insurance company portfolio. But it was really a transition in, probably 6 years ago that someone approached me about getting into the real estate business. And a bright young guy approached me and he said, I've got a unique spin on this single family home rental business. My eyes glazed over. It sounded incredibly boring, but he was very persuasive and he was absolutely right. So I wound up becoming co-chairman and co-founder of Quinn, what is now Quinn Homes, with about 3,000 homes across the country, well on our way to 5,000. I stepped down a couple of years ago. My son's on the board now, but sometimes you listen to bright people and you ask the right questions, and I tend to make very quick decisions. And I have a very simple view. You have to get the big picture, strategic decisions right. The tactical level decisions, of which there are hundreds over the course of the year. You can afford to get a bunch of them wrong, so long as you get the big picture decisions right. By that, I mean, do we want to invest in this business or not? And I'll give you two extremes. One extreme is the Burger King business we were in. I felt like the Maytag repairman. We had a phenomenal management team. They took that business from 3 to 26 million in profits over the course of 3 years. And, I led the charge on acquisitions, but we had a phenomenal management team. The other end of the spectrum is, and I've been fortunate in that I've not had this situation, but I've had colleagues who have, which is you buy a business and it turns into your own little Vietnam. Easy to get in, extremely difficult to get out, and you're getting bloodied, all the while. So, getting those big picture decisions right, what to invest in and what not to invest in, makes all the difference. And so I try to get those big picture decisions right. And fortunately, I've got a great team of people who can get the tactical level decisions correct. I will add that just to answer your question about real estate, from Quinn Homes, we started to take a real hard look at the Miami market. And I happen to believe that, Miami has and will continue to be in the golden age for Miami, certainly for the next 10 years, maybe the next 25 years. Miami's on the map globally these days. When I moved down 27 years ago, people looked at me like I had three heads. Why are you moving to Miami? Is someone punishing you? And now it's the place to be. And so we transitioned into Miami real estate on the development side, and it's worked out very well for us.
Still a lot to unpack there. I think the first one that came to mind, though, as you were relaying all of that, was just big picture. This sounds like your main, what are the main kind of talents that you have is discerning which opportunities are worth pursuing and which opportunities are not worth pursuing at a high level, right? Yeah. Like obviously the tactics, you still have to get the recipe still has to be executed on, but overall you kind of like figure out whether or not this is even something worth pursuing. Is that all intuition for you now at this point? Are there certain parameters or basic principles that you adhere to, or is this something where it's just like, Danny, I've been doing this since 1988. I just know, right? Like, I don't know how to like, I don't know. I can't give you the secret sauce because there isn't a secret sauce. It's just my own intuition.
Well, I wouldn't call it intuition. I would say, I'd say wisdom is the ability to look back on a, collection of dumb decisions made over the course of a lifetime and not make those same dumb decisions again. So, when you mention intuition, it's really born by experience, both my own and that of other people. So I'm a deal junkie. That is a vice of mine. And I think, a lot of people are deal junkies, and human nature being what it is for a deal junkie, you want to get the deal done. And I think what I've learned at this stage in my life is, sometimes it's much better to take a pass. 20 years ago, I probably had a different approach. Everything looked good. And, I took the view that even if the deal doesn't look good, how can I make it look good? And what I've learned is, there's the company, and I'm talking about private equity now. There's the company you're buying. Is that a good company? Is it scalable? Does it have a great management team? And then there's the deal to acquire that company. So it could be a great company, but it could be overpriced. If it's a bad company, there's no price that justifies it. And, I'll give you an example. I was having a conversation last week with a very large private equity firm in the sports space, and they offered up for $1 the acquisition of a very large football club. And I've had some experience in European football. And it sounds amazing. For $1, you can own, a top team. And, it came with a lot of baggage, almost $300 million in debt. And you sit there and you say, all right, for $1, I have the privilege of stepping into, what I referred to before, the other guy's Vietnam. So we took a pass on it. And so, in that case, there was no value at which it made sense to do that deal. So it's a question of just being discerning. And, I remember Warren Buffett once said, and I'm going to paraphrase and butcher what he said, but essentially what he said was, when you're in the batter's box, you can let a lot of strikes go by. So long as you don't swing, you're never going to be called out. It's when you swing and miss that it becomes a problem. And a swing and a miss in my world is, once again, stepping into, I keep referring to it as Vietnam. And the fundamental difference between the private equity business and the capital markets, the public securities markets, is, the public securities markets, you have no control typically as an investor, but you do have the ability to get out and to recognize you can invest today and wake up tomorrow morning, assuming it's not a weekend, you can wake up the next day and get out and say, all right, let me cut my losses. You can't do that in the world of private equity. Once you're in, you're in. So you have to make sure you're right about your decisions. And you're going to be spending a lot of time trying to create value, which is not something you necessarily have to do in the public securities markets. And so that was the big transition for me from public securities to private securities, understanding that, I don't have to pick the top 50 stocks the way I did, when I was young. I just got to pick, the one good company that's going to create a lot of shareholder value. And I can take a pass on a lot of opportunities if they don't make sense.
Yeah, I like the way that you're framing that. Like PE is mostly about value creation, right? And so I think that's something that it's just like a really like easy way to think about it, right? And kind of like regardless of what asset class we're talking about here, whether it's
that's
corporations, real estate, whatever, right? Like long term, it's about value creation. I want to come back to something real quick, and then we'll move forward. The REITs, right? The REIT, obviously, the private REIT, not public. Okay, private REIT, and the LBOs and all the stuff that you're doing before. How were you capitalizing these deals? Were these institutional investors? Are these high net worth individuals syndicated? Like how are you kind of like structuring these deals?
Great question. The first deal we did, which was the Burger King deal, the first deal I did on my own with a partner was that Burger King deal. And I think we raised a total of $15.5 million. Okay. And I think our largest check was with one big investor. He put in $4 million. Everyone else was, 100 to 100,000 to $1 million. So it was really friends and family. The one big investor was a pretty well-known guy, and a lot of people invested probably because he invested, not necessarily because the deal itself looked all that good. With hindsight, it looked like a tremendous deal. Everyone said, "Well, that was a no-brainer," but at the time, we weren't. We were a little concerned. We were a little concerned as a quick digression because this was 2003, so we're talking 20 plus years ago. 6 weeks after we bought the company, mad cow disease hit the U.S., or the fear of it at the U.S.
Oh, yeah.
And so McDonald's took a hit, Burger King took a hit, and we had a lot of frantic investors calling saying, "How could you make such a dumb decision?" And 3 years later, it all worked out.
Yeah, it's that's the responsibility that you take on, right? Whether things go right or wrong, it's always your fault.
Yeah, it's very funny. You're either a genius and you don't deserve to be called a genius, or you're a complete idiot and you may or may not deserve to be called a complete idiot. But there's generally nothing in between. Those are the extremes in my business.
What strikes me about your overall timeline here, Joe, just kind of going through the decades of experience and the different businesses and investments that you've made, is that you haven't necessarily stuck to one individual strategy, right? Obviously you do the LBO, you're doing a franchise roll up with the Burger Kings, and then you got the REIT going on. You've got a sports, GACP Sports.
Yep.
Am I making that up? Okay, no. So you've got you're playing in a lot of different arenas, which is because that's cool. Because I feel like a lot of people, they just going to stick to one strategy. So why is it that you think that you've been able to be so successful across a myriad of different asset classes and strategies?
Well, I think first of all, there's a bit of a method to the madness in the following respect. So I do think through a certain prism, and one of those prisms is a buy versus build prism. So once again, I'll go back to the Burger King example by way of example. I'll cover a couple of others. When we bought these Burger Kings, we were essentially paying about 2 times cash flow, and so all in, about $110,000 per store. When you
2x EBITDA,
2x EBITDA.
Okay.
Yeah, so it was very, very inexpensive. And we got that mostly because we were able to renegotiate rents, and there were a few other concessions we got from Burger King. But the prism through which we looked at it was to go out and build a new Burger King. And I'm not talking about buying the real estate. I mean, just buying the equipment, putting the deposit down on the lease. Back then it was about $500,000. So you can buy a Burger King for $110,000, or you can build one for $500,000. You don't have to be a rocket scientist to figure out, let's buy instead of build. And by the way, the year 2003, I think Burger King had about 7,000 franchise units globally. And I think they had maybe 15 new stores built that year. So I wasn't alone in realizing it made no sense to build when you could buy. And there was a lot of acquisitions of existing stores. And, everyone bet on the fact that Tech Specific Group, Bain and Goldman would get the brand turned around, which they did. They did a phenomenal job. In many respects, we rode their coattails. In other respects, I had a phenomenal management team that executed flawlessly. But getting back to the main point, I look at deals through that prism. Do we buy or do we build? In that case, it made sense to buy. In the case of the REIT, we talked about Quinn Homes before, it made more sense to build from scratch. So the arbitrage there is, you could go out and buy 1,000 homes, and it'd probably run you about $300,000 per home. Or in the alternative, you could, build from scratch at a fraction of that price. So the arbitrage there for us was, okay, let's get to 1,000 homes. We'll sell the portfolio. Well, we've kept the portfolio. We're at about 3,000 homes now, and we continue to create value because it's still much better to build than to buy. And
when you say build versus buy, you mean you're developing these single families.
That's right. Exactly.
I see.
Yep.
I see. Gotcha. Understood. Yeah, that's great. And so the thing that you're working on right now, if I'm not mistaken, and forgive me if I'm wrong here, is Axxes Capital.
That's right. Yep.
So I want to learn a little bit. I want to hear a little bit more about Axxes.
Sure. Having been in the capital markets now for, pretty soon I'll be in 2026, it will be 40 years in the capital markets. So
it's awesome.
I hate to date myself, but I mention it for the following reason. There's been 4 or 5 major capital markets events over the course of my career where I've said, gosh, I wish I had taken advantage of that. So, I'll give you an example. Charles Schwab back in the 80s and 90s introduced discounted commissions, destroyed Wall Street, from a commission point of view, created massive shareholder value for Charles Schwab and others. That's one example. John Bogle, with Vanguard, delivering index funds, low cost alternatives to high price mutual funds. So, there's been a number of these, tectonic shifts in the capital markets. And I think we're about to experience the single biggest tectonic shift in the capital markets, which is the reallocation of retail money from public securities to private securities. So institutions have reallocated into private investments, private equity, private credit, real estate. You get to, family offices, they're about 27% invested in private investments. You get down to the, to the average retail investor, they're about 1% invested in private investments. So, I started hearing about this, early stages of a 10 to 20% reallocation. I mean, Larry Fink at BlackRock was talking about a 20% reallocation among retail investors into private securities. And I said, that sounds pretty interesting. Let me look at the numbers. And so you're talking about an 80 trillion portfolio waiting to be reallocated, 10 to 20% of that into private investments. The only way to do that is through publicly registered vehicles. So the vehicles have to be registered with the SEC, like mutual funds. And so we're coming out with a line of they're called interval funds, semi-liquid products. But, to the question you raised, why do we do it? We said, okay, there's going to be this massive reallocation. We want to own a business that is going to be able to, to capitalize on that huge, massive reallocation of wealth. And I think it's going to be the single biggest reallocation of wealth that certainly I'll see in the course of my career.
Yeah, 100%. Well, and this is actually something that I talk about over and over again on this show. And it was actually the impetus for me changing the name of this show, because it was something else before. And right now we are at a point where, like, you said 1%. It's like 95% of America, or the majority of Americans have zero exposure to private markets.
Yeah, absolutely.
Right? Zero exposure to
you have
private
no question
markets.
about it.
And the average American has 95% of their investable assets in public securities.
Yep.
Isn't that crazy?
It is crazy. Yeah.
That's insane.
Well, particularly given where valuations are, and we don't need, reasonable people can disagree as to whether the market's going to continue to go up or not. But, prudence would suggest that you want a diversified portfolio. And when, 2/3 to 3/4 of all the businesses in this country are private, not public, from a valuation point of view, stands to reason that you want to figure out how to get some exposure there.
Right.
And so I think it's just a matter of time. President Trump just signed an executive order recently to enable 401k plans to begin to allocate to private investments. There's some
really
incredible roadblocks right now. And so I think those barriers are going to come down. And over the course of the next, I think it'll be 1 to 3 years before we start to see, a material shift in 401k plans. But there is going to be a big shift. And I think it's great for the average American investor. Because if you are a policeman or a fireman and you're part of a big, defined benefit plan where a bunch of folks sit in a room, half a dozen people decide how $1 trillion is going to be allocated, that's great. You're going to get your exposure to privates. You may not even know it, but you will get your exposure. But, if you're self-employed and you have a 401k plan and you have employees right now, you have no ability to allocate to private investments. So President Trump changed that with a stroke of a pen. A lot of regs have to come into place to protect people. But I think it's going to be a good thing.
Well, I don't know if that, if you're self-employed, you can do self-directed IRA, right?
Yes.
And then put that with a custodian and then make investments that way. But here's the thing. No one knows how to do that.
That's true. Yeah.
The education is simply not there, right? Most people have no idea. They have no idea this exists, you know, Joe. And you know what the moment that this clicked for me, by the way, is I was on the phone with a very sophisticated real estate developer in my neck of the woods in the San Francisco Bay Area, Silicon Valley.
Yep.
And I was talking to this guy and we're chopping it up. He had developed several luxury homes. So he's a luxury home developer, and he owned about 40 or 50 rentals in the Phoenix market. So, one would assume that somebody that's building $3 to $5+ million homes and has 40 plus rentals in Phoenix, it was probably worth a decent amount of money, right? Like, I don't know how much, but one would imagine several $1 million plus. And then I asked him, I said, well, what do you think about, have you invested or have you considered investing in real estate syndications? And you know what he says to me, Joe? He says, what's that?
You're kidding.
Wow. And
That's
I was
shocking.
like, what? Exactly.
Yeah.
Right. That was the aha moment for me, because I realized, hey, like, if this guy who has all this real estate exposure, presumably very like financially literate, or at least to the degree that like in the real estate space, right, would be like, I had no idea what, and then, after a while, like after I explained it to him, he was like, oh, he's like, I kind of know what you're talking about, whatever. And I was like, how does this guy not know what a real estate syndication is? And so that's surprising. And so that's when I realized that most Americans, like, if this guy doesn't know about it, if this guy doesn't, like, he doesn't know about he probably doesn't know about any alternatives, right? He's probably heard the word hedge fund before, but he doesn't know what hedge funds actually do, and so there's this whole world. And, Joe, I think that the big part of it is that, we throw, like, in this space, we throw around all this big vocabulary, and I think people just kind of get intimidated, right? By alternative investments in general. The name itself sounds kind of like odd. You're like, it sounds kind of sketchy. Alternative investments.
Right.
Yeah. I don't know. So I think that you're definitely onto something. I've heard about interval funds before. I want to talk a little bit more about those though, because, I want to understand them better. So what is an interval fund? Let's just start there. And then we can, I know that it's like semi-liquid, right? So I have some So
I'm going to first talk about traditional private equity funds, and then we'll sort of compare and contrast. So a typical private equity fund, you have to be what's called a qualified purchaser, meaning your net worth is 5 million or more. And there's the Investment Company Act of 1940 essentially says if you're a qualified purchaser, you have 5 million or more, you, along with a whole bunch of other QP accounts, QP investors, can have an unlimited number of investors. So if you're a general partner, and I used to run a fund when I was at Maplewood Partners, we would limit our investor base to qualified purchasers. What does that mean? It means the vast majority of Americans don't meet that QP designation. And so that means all these people are disenfranchised. So getting back to the main point, the traditional, we call them drawdown vehicles, a wealthy investor might commit $1 million. And that capital is drawn down over the course of 3 to 5 years as investment opportunities come along. But from day one, you're paying management fees. Typically, you're paying 1% to 2% on the capital you committed, not on the capital you've delivered. So you may have committed $1 million. There may not be a capital call, a request from the general partner for a year or 2 or 3, but you're still paying that management fee. Then you're waiting, these funds go out 10 to 12 years. You have no liquidity while you're waiting, and you really have no visibility on day one as to what you're investing in. You're basically making a bet on the general partner. Compare and contrast that to an interval fund. So first of all, the interval fund concept is driven by the fact that at certain intervals, you do in fact have liquidity. So you put in, you can invest these days for as low as $5,000, typically $25,000. So you don't need $1 million. You can invest as little as, say, $25,000. And you have periodic liquidity at certain intervals. So right now, those intervals, for the most part, are every quarter, every 3 months. You can get, where the fund will make available 5% of the assets in the fund. So if the fund has $1 billion in it, every quarter, $50 million is made available for redemptions for people who want to get out. And if you want to exit, you can get, some, most, all, depends on how many other people are requesting their capital. But the beauty is there is a level of liquidity there. In addition, that capital is going to work right away. You're not waiting years for that capital to be deployed. So you're not paying management fees on undeployed capital. And typically you have visibility into the portfolio. I mean, these interval funds are registered with the SEC. And so there are periodic, monthly actually, reporting requirements to the SEC. So there's a lot more transparency. There's liquidity, and they're far more efficient in terms of not, paying management fees only on capital that's being put to work where you're generating a return. So I think it's a much better alignment of interests. Our view or our approach in our business, Danny, is, we look at the financial advisor as, the conduit to all these accredited investors. And that's our target market, folks with 1 to 5 million that don't meet that qualified purchaser designation, but can in fact invest, provided that they're investing through a registered vehicle like an interval fund. And so it's a massive market. About 20 million households in the U.S. meet that accredited investor standard. As I said, 80 trillion in AUM across all those accredited investors just in the U.S., almost double that globally. And so it's a big untapped market.
I mean, I completely agree that we could be doing a lot better, democratizing this, these types of investments. I didn't realize, I have to forgive my own ignorance here. I thought that most PE shops took accredited investors. What you're saying is that most of them have to be QPs. So that's
no question about it. So just about every private equity and credit shop that is bringing in institutional capital for a vehicle relies on that safe harbor provision in the 40 Act that says you need to limit your investor base to QPs. Some firms have decided to launch interval funds, and there's other types of funds. There's tender offer funds, there's BDCs with different constructs. But the bottom line is the interval fund structure is the future. I have no doubt about it. I think there's, call it about 140, 150 billion in interval funds today. I think it goes to, 2 to 4 trillion over the next 5 to 10 years. It's going to be a massive reallocation into these vehicles.
So each of these interval funds, presumably, and I actually had another gal on here. Her name was Kimberly Flynn. I don't know if you've heard of Kimberly or not, but she, really smart lady. She was telling me, she was explaining interval funds to me as well. My understanding is that much like a lot of these other alternative investments and whatnot, or a lot of other alts, like you kind of pick a lane, right? Or you pick a strategy, right? So these funds all have specific strategies. So you're still investing into a thesis, right? It's not like a S&P, or it's not like a index fund where you're just kind of like, okay, well, I've got this a wide ranging exposure across a variety of different sectors, right? It's just like, hey, we're picking a lane. Yeah.
Yeah. Yes. And the way we think about it, the prism through which we think about interval funds and how people invest, maybe that's a better way to describe it. Now, this goes back to my days when I was managing money for people. When I started in the business, we were called stockbrokers. By the time I left the business, we were wealth advisors. So what is the difference? Stockbrokers were buying and selling individual securities. And I mentioned Charles Schwab. He decimated the world of buying and selling individual securities because commissions got driven into the ground. So the industry moved into the wealth management business. And so what did that really mean? It meant, no longer were we trying to decide whether to buy AT&T and sell Microsoft. Instead, we were looking at equities and we'd say, okay, we've got 3 or 4 different strategies within equities. So there's growth, there's value, there's domestic, there's international. I'll use that by way of example. So there are sub-strategies within equities. We're at a point today, obviously you can invest in the, in the telecom sector, or you can slice and dice to a very, micro sort of strategy. But at the end of the day, the job of a financial advisor is to get the overall asset allocation right. So we apply that same formula. Even when you think about fixed income, you've got, high yield, you've got investment grade, you've got international bonds, you've got governments, you've got all different sub strategies. But there's, 4 to 6 core strategies. So we take the same approach with private investments. We say to help an advisor and a client invest in private investments, what are the sub-strategies they should be in? And so we think in terms of private equity, venture capital, real estate. On the debt side, we're in direct loans. We're in opportunistic credit. We're in infrastructure. Those are our 6 core strategies. Because if you get those strategies right as an advisor, and you partner with the right firms, you're going to deliver value to your clients. And, that's what we try to do. Having done this myself, managing client portfolios, all I wanted to do was get the overall asset allocation strategy right. If I did that, we could deliver performance to clients and, let them sleep at night because they were properly diversified.
Yeah. Makes perfect sense. And so your primary strategy then, Joe, is not going direct to consumer, but rather you're going to advisors, right?
That's right.
Now, you're not going to the wirehouses, right? You're not going to the big guys, right? You're going to the RIAs and like the smaller boutique shops, correct?
Yeah, and there's really a method to the madness to that. So, I used to work for a big wirehouse. PaineWebber was acquired by UBS.
Yeah.
And when I was at PaineWebber, I think we had 8,000 advisors. I don't know what it's up to now. But the wirehouses generally deliver either their own proprietary product or they're bringing product from very big names that are paying for shelf space. And an interesting thing has happened over the past 10, 15 years. You had a lot of folks leave the wirehouses and set up their own registered investment advisors. Literally, they hung out their own shingle. And fast forward to today, over the past, call it 5 years in particular, you have the rise of the RIA aggregators. These are private equity firms that have decided to roll up the industry. The result of which is you've got these very large RIA aggregators. They rival the wirehouses in terms of assets under management. But what do they lack relative to the wirehouses? They lack product origination and underwriting. And that's where we come in. We can plug and play with these large RIA aggregators and deliver a turnkey solution to enable their clients to reallocate into private investments. That's our value added at the firm level and at the advisor level. And at the advisor level, we're very big on education. We just came out with a book called The Financial Advisor's Guide to Private Investments. We're all about making sure advisors, can intelligently explain to their clients, the risks and rewards for different types of strategies and why they may want to consider allocating.
Yeah. No, I mean, this all makes perfect sense to me, Joe, because this is something that I've been very passionate about for a very long time, is doing my best to educate the masses on alternative investments, because it's first of all, it's not simple to understand. It's not something that a lot of people, like, there's sales resistance there. Yeah. Right. There's a massive sales resistance. And so I think that the funny part is that we're really not, like, I don't really have anything to sell them. You know what I mean? It's just like, but I do see more and more, kind of like people kind of coming to this. So I think you're getting into it at the right time. I really do. I think we are, we're, as I said, we're a big believer in working with financial advisors because, my bias is I used to be a financial advisor, and I have, pretty good understanding of how people think. And, my clients, my best clients, were the ones who viewed me as their friend, their advisor. And, I would joke, to this day, I probably should have gotten a psychology degree instead of, a finance degree because I spent more time being a psychologist to clients. But, when you build that kind of relationship, clients, typically will listen to what you have to say. It doesn't mean they won't question you, but if you make, if you're making sense and they know you're out for their best interest, it's really the financial advisor who's going to drive that reallocation of wealth into privates. And that's why that's our target market. Obviously, interval funds have the advantage of being diversified within a certain thesis, right? And I'm assuming that these funds are also diversified across operators, right? Like you're investing into different groups or no?
So, our approach, and I want to be very sensitive to the fact that I don't want to come across as selling. We've taken one approach, others have taken a different approach. My approach is I want to find firms that can deliver alpha meaning performance over and above what the returns might be in that particular asset class. And so by way of example, take private equity. We tend to target firms that, we do target firms that are top quartile performers in private equity. Same thing with direct lending, same thing with opportunistic credit. So we're looking for managers that can deliver alpha because there's, my view is in private investments, the mean returns are going to be, depending upon whether you're talking about equity or debt. If I as an investor am being asked to go into an illiquid or a semi-liquid portfolio, I want to be compensated for that. So I would expect on the equity side to get, 200 to 500 basis points more than what I would otherwise get in the public markets, just to compensate me for the illiquidity.
Right.
On the credit side, it's probably 100 to 250 basis points, depending upon the strategy. If you can find, and the mean returns for the strategies I described, deliver those sorts of incremental returns. You can almost double those incremental returns if you can identify the top quartile performers, in a particular strategy. So my view is, let's spend a lot of time looking for great managers, because we want to deliver not just mean returns, but alpha over and above what investors would otherwise expect to receive. So what does that mean? We tend to go with managers who build diversified portfolios for us, but we're not out like some of our competitors that are partnered with, some cases, as many as 40 or 50 different firms. That really turns into a beta product. What do I mean by beta product? I mean, it turns into a portfolio where you're going to get the mean returns for that particular strategy. And I'm a big believer, if you're going to pay the fees associated with being in private investments, and the fees are higher, if you're going to pay those fees, you should be getting better than average performance for that particular strategy.
Yeah, of course. I mean, it makes perfect sense, right? Like, why would you pay more for, the same thing?
Yeah,
right.
Exactly.
It doesn't make sense, right?
Yeah.
And of course, I think a big part of this too, Joe, is salesmanship. You've got a lot of these different groups and stuff that they do a great job in marketing themselves, and that's something that I warn people about. Is like, typically the ones that a lot about are not the ones that you would invest into.
It's true.
It's like the guys that are kind of hiding in the shadows, and
right.
They work in a basement all day, and not really, you know what I mean? But like,
I know exactly what you mean. I mean, when we're looking for managers, I told our team we're looking for Goldilocks managers, not too big and not too small. But they need to have the right pedigree, meaning not just track record, but they've been around typically 20 plus years, because, we're not in the business of making bets on, guys who just, hung out a shingle and now they're in the private equity business. They may have done great at Blackstone or Apollo, but it's a very different business when you're running your own private equity shop. So, we look for firms that, have that experience, that have strong compliance, have the experience, have a transition plan for the next generation of folks that are going to come to work for them. For a very simple reason, Danny. I described that drawdown structure before, where you're locked up for 10, 12 years. Well, these interval funds are evergreen vehicles. So from my perspective, I'm getting married to a manager. I have to make a big bet that a manager is going to continue to succeed. And that's why I want to see that 20-year track record, where, they've dotted the I's and crossed the T's. So not only do we underwrite the managers, but we use a third-party pension fund consultant to make sure we're not making some dumb mistakes on our side and we're not missing anything. We subject, our managers to background checks. I mean, it's like sitting in a dentist chair for about 6 months if you're going to be a manager for us.
Yeah. That's awesome, man. That's really, really cool. So obviously the funds and everything, or the interval funds that are being put together, are being managed, right, by like certain groups or whatnot. And your platform you've essentially built out a platform for all of these groups to kind of like come into, or all these managers to basically put their product into, their fund into. Yeah.
Well, it's A little bit better than that in the following respect. So
educate me, because now I want to understand the nuts and bolts, right?
Think of each of our funds as being an Axxes fund. So the Axxes private equity fund or the Axxes direct lending fund. And think of that, old Intel commercial, like Intel Inside, if you're talking about a computer. So think of these managers as being behind the scenes, but driving the return. So we are the advisor, and we'll enter into a sub-advisory agreement with these managers. And we set up a separately managed account. So we're not commingling with their other funds. They are literally responsible to focus on our vehicle, with no distractions from other investors in our vehicle. They are managing our interval fund. And it's very effective. Now, from the manager's perspective, it makes all the sense in the world, because we're delivering the largest unmined pool of capital in the world that doesn't cannibalize their institutional client base. So we're bringing a fresh set of capital, but we expect them to treat our interval fund and our retail investors, with the same sort of focus and attention that they're giving to their institutional clients.
Understood. Yeah, makes sense. You're effectively bringing them a massive network of
that's right,
of investors. Yeah. Fundraising at scale. No, I love it. I mean, I think it makes a lot of sense to me. It's, I mean, it's, could definitely see that being very lucrative too. So I'm sure but you're filling a need. And I think that's the important thing. And the thing that kind of, really stuck out to me, one of the very first business podcasts that I listened to, when I just graduated college, and I remember something that stuck out to me. A really successful guy on the podcast, and they said, what's your business model? How do you do what you do? And the guy said, I find a need and I fill a need.
Yeah,
it's like I find a need, fill
that's
a need.
Right. It's really that simple. And that's that's what we did with Axxes. But there's another element to Axxes, in that there's another need that we're filling that we don't really talk too much about, but I'll mention it here. I mean, the main point is we're serving accredited investors. That's our target market. They're underserved, and we talked about that. But the other key market is you've got these big asset management companies, like T. Rowe Price or AllianceBernstein, or these big names. They've gotten decimated from ETFs and index funds. So, Vanguard has destroyed their margins. Now, all of a sudden, but they're all in the public securities business. So they risk losing 10, 20, 25% of their assets to private investments. They have to get into this business. So I started this business, one, to fill that unmet need for accredited investors, but two, recognizing that, there has to be an exit at some point. And the logical exit is one of these big asset management companies have to get into this business. And going back to that prism through which I view the world, buy versus build, if they're not building now, they're going to have to buy in 2 or 3 years. Otherwise, they're going to be, they're really going to get creamed by the market. So we're focused on those firms that aren't building right now, because we know they're going to have to buy in 2 or 3 years. So, it's theoretically a logical exit plan for us.
Always one step ahead, right? Couple steps ahead.
Try it.
Love it, man. I love it. Joe, this honestly, man, might have to have you on again. I love chopping it up with you, and sounds like you've got, not sounds like, obviously you have a wealth of knowledge and experience, and a very interesting kind of pathway to where you're at now. You've done really well in a lot of different silos, and I think that's it's not there. It's pretty rare. It's really, really rare. Normally, they stick to a lane and they execute on it, but very rare that I've encountered someone who's been as successful as you have in a variety of different silos. So, kudos to you. Before I let you go, a couple things. Yeah, of course, Aaron. So first thing, if the people want to get a hold of you, if we've got some RIAs, financial advisors, that want to learn more about Axxes, how can they find you? And keep in mind, all of this will be in the show notes in the description as well.
Yep. No, I'm very accessible. Joe at accesscapital.com, and it's AXXES capital.com. And I'd love to hear from any of your viewers. It'd be, I enjoy interacting with people.
Awesome, man. It's awesome that you're that generous with your time. Before I let you go, we do. I'm not going to let you leave the vault, Joe, without giving the viewers, giving the listeners one final investing secret. Take it away.
Well, let's see. I'm not so sure I can give a secret, but I will tell you where I'm starting to look in terms of the future. And, you know, we all want to take that sort of Wayne Gretzky approach, which is to skate where the puck is going to be, not to where it is. And so, you know, we're taking a real serious look at tokenization. And I am not a crypto guy. I never have been. But I think the world is going to change pretty radically with respect to tokenization. I watched a video, and your viewers may be interested on YouTube. I watched a video of Larry Fink from BlackRock, and you know Larry has 12 trillion in terms of AUM. So he's got to figure out how do you build a business that continue to build a business that already has 12 trillion. And you know it was sort of eye-opening where he said, well, you know, I found one interesting area, and that's the 300 trillion global real estate market. And tokenization is the future to democratize the ownership of real estate globally. And so that's a business we're taking a real hard look at. And I think you're going to be hearing a lot more about it over the coming months and years.
You know, as a real estate guy myself, I've been so resistant to crypto, man. You know, I've just been, I was like, oh, it's just pretend money. It's fake money. And mind you, like, you know, I went to Stanford. I've got a lot of Stanford. In fact, my best friend is CTO at like this new crypto startup and it's done incredibly well. And he's tried to get me to invest in crypto and whatnot. But I think the further along we get into the further along we go, the more I realize this is no longer like a fad. It's like here to stay. And the tokenization part of it, that's really like, it's not in crypto. Like we're talking like blockchain. We're talking about the actual technology right behind it. And I think regardless about how you feel about it, doesn't really matter what you feel. It matters like what the reality of the situation is, right? Which is we're kind of moving to that. So I begrudgingly agree with you there. And I'm gonna try. I myself feel like, okay, that's maybe a wake up call for me too. But yeah, Joe, this was great, man. Glad to have you on.
Thanks so much,
best of luck
Danny.
to you with Axxes. And next time I'm in Miami, I will let you know.
I look forward to getting together. Thanks so much, Danny. And thanks to all
great.
your viewers. I really appreciate it.